My thinking is eventually the dollar breaks down, mainly because I don't believe that the Fed will be raising rates in September or anytime this year. We did have a Fed official come out yesterday and say that she felt that there was at least 2 rate hikes needed to make any impact on inflation. But we know how the president feels on this. And therefore, even though, like I said, Kevin Warsh talked a tough game, there was really no bite behind it. And so I'm still in the camp that until the Fed shows with action that they have a backbone on inflation, I'm a doubter. Silver blew through resistance at 64. It's stalling. I want to see if it can confirm above 64. All right, that's going to be the big question mark here. Right now, it's pulling back a little bit in the pre-market. One of the things to keep in mind is that silver and gold will likely have big moves tomorrow on the back of the CPI data.
Gold is testing key resistance near $4,400 after an explosive rally, while silver just blew past the crucial $64 level and is battling to confirm above it. With crucial CPI inflation data dropping tomorrow, markets are on edge, bracing for massive price volatility across precious metals, yields, and the US dollar. Is this the trigger for another historic leg higher, or are we heading straight into a major pullback? In today's breakdown, market expert Gareth Soloway reveals why he's highly skeptical of Federal Reserve rate hike talk and outlines the critical technical levels traders must watch right now. From gold's key $4,170 support level and a high probability swing trade setup in GDX to why he remains ultra bullish on Bitcoin following its long-term chart breakout, Gareth shares his exact playbook. But what specific support level could break and completely unravel this gold rally overnight? Watch until the end to find out. But before that, if you find this analysis helpful, please hit the like button, subscribe, and turn on notifications so you never miss our deep dives into the markets. Thank you for watching, and let's get into the video.
Let's talk about gold and silver. So gold today is fractionally higher. Again, it's right into that $4,400 level here. And again, this is the upper range of resistance. It's had an amazing rally, but this is where we start getting into all of these pivot points in this vicinity. So watch this today. Can it push through or does it stall out? And right now, again, it's up a little short-term extended. We'll see if it gets a pullback. If it gets a pullback, how big of a pullback? What I will tell you is that you now have a support level on gold at 4170. Pivot high here, pivot high here. On a retrace, this would be your first level to watch at 4170 to see if it holds. If it breaks that, you likely head back down to around 3,900. But right now, this was a wedge pattern breakout up to resistance. If it pulls back, the buy level becomes 4170. Now, one of the other charts I'm watching is GDX. GDX had a great wedge pattern breakout as well. GDX in my commodity service, I'm watching, and where I trade commodity and commodity ETFs, this is a very important resistance level. I would even consider a short trade, just a swing trade, a quick trade, if it were to zoom up straight into this 93.85 gap fill right there. So here's your gap, and obviously filling, just like we discussed on the opposing side on semiconductor, this would then act as resistance. So that would be a little pullback. Look at the extension move up. You're even getting into a time count if it were to hit today or tomorrow, and a good potential pullback. Silver blew through resistance at 64. It's stalling. I want to see if it can confirm above 64. All right, that's going to be the big question mark here. Right now, it's pulling back a little bit in the pre-market. One of the things to keep in mind is that silver and gold will likely have big moves tomorrow on the back of the CPI data. So watch tomorrow, the dollar, yields, gold, silver. I mean, everything is in play because obviously inflation numbers, which then affect probabilities of rate hikes or cuts, are going to be influential in all of those assets. Going on here to a couple others, we discussed oil. Oil yesterday had that big move. Today, it is down a little bit on the day, as we discussed. It was up overnight as high as about 84.75, but has now pulled back. And really, like I said, guys, we're now in a wedge pattern. And so for wedge patterns, as you guys know, price, I mean, when it was down here and it was so oversold, it was a no-brainer buy. It was also a gap fill right here. Then when it came up here, we shorted it, right? Tons of resistance here. Now you're getting in tighter ranges here where it doesn't really make sense on a swing basis to trade those opposing levels. So what I do is I just sit on the sidelines and wait for a bigger setup to come that will get me off my seat to trade oil. Right now, there's nothing there. Natural gas, let's take a look at that one. If we look at natural gas, basically flat to positive today, had a good couple day bounce here. But notice again, where did it go? It went right into short-term resistance. Low pivot, high pivot, pulls back, makes it lower low, and then hot into that. Now, if it can break through here, it can trade up into this, 294, 295 range. But right now, that is your resistance level. So keep an eye on that, guys, on natural gas. One thing I'll keep an eye on as well is if we pull back here and then move back up, do you then get an inverse? Is that a small inverse head and shoulders, which it would be? That could be bullish, but we don't know that yet. It hasn't formed that right shoulder, inverse shoulder just yet on the charts. Flipping over to Bitcoin. Bitcoin had a down day today. Pretty nice sell-off on Bitcoin yesterday, but there was a reason. The reason on Bitcoin was that Michael Saylor and Strategy had to sell about $100 million worth of Bitcoin, and they used those funds to buy the SRTC stock, which again is the dividend payer for Strategy, right? And so you had Michael Saylor unloading. Now remember, the last time he unloaded, the stock or the Bitcoin chart fell a lot. Here it actually only fell about 2%, so it wasn't a big drop. And keep in mind, the chart on Bitcoin has still broken out. And so again, just to go back to the charts and look at this is really key here, is that you have still broken out of this longer term trend line. And I would remain bullish, even if you pull back to this line, as long as this line holds, this chart should catapult higher. And I remain long on Bitcoin. I remain bullish on the chart as long as the white trend line holds price. This is a good chart setup.
Beyond precious metals, Gareth Soloway is raising major red flags over the tech sector, warning that high-profile mega deals like BlackRock, joining forces with Nvidia, mirror dangerous dot-com-era mistakes, ranging from circular financing and off-balance sheet debt to rapid GPU obsolescence. Meanwhile, the S&P 500 is hovering at critical technical resistance, forming a bullish consolidation pattern that could propel the index up toward $8,100 to $8,200's expanding M2 money supply continues to flood the system with liquidity. However, with 10-year Treasury yields stubbornly pinned near 52-week highs, the bond market is signaling that inflation isn't going away quietly, rendering Fed rate hike talk questionable at best. With tomorrow's high-stakes CPI, inflation release set to dramatically shift September Fed rate odds and trigger huge moves across equities and the dollar, are we on the verge of an explosive stock market rally, or is the AI bubble about to face a brutal reality check? Watch to find out.
And what I'm concerned about here is that we get into a situation where you get this kind of round robin, right? So you have other companies putting in money, it rotates into Nvidia, which then buys chips, and it rotates the money back out. And again, it's concerning only because this just breeds more question marks of, are we repeating the same mistakes that occurred in the dot-com era? Is there going to be an overbuild out? Circular financing, rapid GPU, will they be valid? Will these chips be valid for more than 2 or 3 years before the new technology is brought out? AI demand overbuild, concentration in one chip maker, and obviously the biggest to me, the debt factor, off balance sheet leverage. So these are the types of things that are concerning me. And when I look at this, it sounds great on paper to have the mega financial firms like a BlackRock joining forces with Nvidia. It sounds like it's a confidence builder. But again, is it truly going to pay out? Is it something that is building something that will eventually collapse later on? Time will tell. But right now, that is the story of the day. So we'll keep an eye on that and see where things go. If we go to the S&P 500 and we flip to the daily chart, remember, we were at resistance on the charts. How do we find resistance? Well, we zoom out and we take our COVID low. We drag it up through these two pivots here, and it goes exactly to the last two highs in the market. So yes, we're at resistance, but remember what I said to you yesterday is that as long as we're going sideways like this, you're actually building a bull flag for a potential move up. And right now, today fits in that mold. Yesterday fit in it as well, with the S&P only down 4 points, less than 0.1%. And so far, it is building that bullish consolidation zone. Now, if we go higher, I explained this yesterday, when you look at the S&P in relation to M2 money supply, there's a level where it could take the S&P to 81 to 8,200. Granted, that's only a 6% move up in the S&P, but that would be my major resistance. That would coordinate with a parallel channel that goes back to the dot-com highs on the S&P in terms of M2 money supply. And we talked about this yesterday, how M2, you really do want to pay attention to M2 because M2 is the money supply out there, all the money out there. It's continued to go up and up and up. There's more liquidity in the system, and therefore it allows for more money to find the stock market and allows for the stock market to go up, right? So keep that in mind. Next up, let's take a look at the dollar today. The dollar is basically, this is the 10-minute chart, but the dollar still holding technical support here. Again, my thinking is eventually the dollar breaks down, mainly because I don't believe that the Fed will be raising rates in September or anytime this year. We did have a Fed official come out yesterday and say that she felt that there was at least 2 rate hikes needed to make any impact on inflation. But we know how the president feels on this. And therefore, even though, like I said, Kevin Warsh talked a tough game, there was really no bite behind it. In his last press conference, he didn't give any details about how they were going to do it. He didn't push anyone. And that kind of freaked the markets out that one day. We had that big sell-off after the press conference. And so I'm still in the camp that until the Fed shows with action that they have a backbone on inflation, I'm a doubter. Like I said at the beginning, I'm a skeptic overall on most things until it's proven. All right, a couple other things here. The 10-year yield, which was up yesterday, it was up overnight. It's coming in just a little bit today, so that's just something we want to keep our eyes on here. But again, notice how the 10-year yield is still basically at 52-week highs. Now, if oil was the only culprit for that, then remember, oil was at $120 a barrel. And even at 80 or so, where it's currently trading, it would signal that the yield or the interest rate should have come in. The fact that it's staying high is telling you that the bond market, which is known as the smartest money in the markets, does not believe inflation's going to get back in the bottle. They believe that it will continue to be a problem and something that is not, essentially a going away problem just because oil comes in. All right, so again, 10-year yield continues to be on my radar. It is down slightly today, trading at 4.686%. But again, we'll keep that on our radar. And don't forget, like I mentioned, guys, the CPI data tomorrow, that will be probably the most important data point this week in terms of economics, and it will shape the Fed watch tool. It'll change up whether or not it'll probably either push, if inflation is hot, it's going to push the odds of a rate hike in September up dramatically. If it's neutral or negative in terms of lower than expected, it'll drop that odds back below 50%.
Gareth Soloway's overarching takeaway is clear. The current market environment demands extreme technical discipline rather than blindly buying macro narratives. While mainstream headlines focus heavily on Fed speak and temporary earnings spikes, smartest money indicators like the 10-year Treasury yield and off-balance sheet leverage reveal a much more precarious reality. Traders who succeed in this volatile regime won't be the ones chasing breakouts at major resistance levels. They will be the ones waiting patiently on the sidelines for confirmed chart signals and pristine risk-reward setups. As structural debt risks and inflation pressures continue to compound beneath the surface, keeping your emotions in check and strictly honoring key chart levels will determine who thrives and who gets wiped out. Which critical price level are you watching closest before making your next big market move? Let us know your thoughts in the comments below. If you found this breakdown helpful and want to stay ahead of these historic market moves, make sure to like, subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.